Good evening, guys. Ken at Tortoise Capital. This is the Saturday night strategy podcast for June 6, 2020. So we had, I did 9 hours with the hybrid trading workshop guys. There were it felt to me like some amazing moments in communication today. So that video is processing. It's going to make a pretty good addition to the hybrid trading course. I'm really pleased with the way the narrative went, and got some work to do with them tonight for framing some trades that come out of the weekend report review. So I'm going to go through that one pretty quickly and just point to a couple charts we did for today that with the promise that they'll be part of the nightly strategy podcast I upload later. I got to get that video, still 3 or 4 hours of processing yet to do. So let's just jump right into the report. And I want to start by saying that due to the nature of that amazing gain, the big surprise that unemployment report was much, much better than expected. And the huge response across the index and all the sectors, with a few notable exceptions. It looks to me like Monday's trade is really going to be about the market and the response, because I think that there's probably 3 groups of people ready to act on Monday. There's going to be a bunch of people that have to get in because they realize, oh my goodness, that was so great, and they got to get in at any price. There's going to be a group of folks who think, man, there's no way that's justified. This is just more reason to get short. So there will be some real interest in punishing that market and try to get it back to fair value. And then just, some group of tactical traders that are ready to reinforce momentum in either direction. That would be me. I don't have an opinion on where it's going to go. I just think it's going to be a really big move Monday. I'm prepared for a lot of volatility, so that tells me that Monday, for me, is going to basically be a intraday trading with hybrid frogs, and then in the afternoon, when I see what how the market is wanting to close, I'll make decisions about whether to hold it overnight or not, and in which direction. I just don't know how you can take a short position overnight on that, given the amount of the Fed backing and that amazing response to the long side that finished well. In the absence of other news, I just don't see how you want to be on the other side of that trade. So I'm expecting some tactical pushback, but I would be surprised to see a significant move down. So I'll be prepared for that because I've been surprised before. But I think this one is much more about the getting the market call right. And I'm going to make one exception on this. And I'm going to say the semiconductors, when we look at this report, it really stood out to me as being very well postured. And the clean energy ETF, PBW, both of those ETFs really struck me as being leaders of the pack in subtle ways. Okay, so here we go. So we're in bullish normal conditions. That favors the long side and taking long side swing trades. The NDX for every look back period is significantly overbought. That is just as uniformly positive as it can be. That may be the best reading on it I've ever seen in memory, where all of them are that good, that long. There may have been some times back in middle February it was that good, but boy, this really stands out. The market mosaic at we are 4.25% better than the sideways criteria, so we have a nice cushion to be in the bull. The ADX has strengthened now to 20, and the bullish side is winning. Not an overly strong trend yet, so there's still room for it on the upside, but the bulls are winning. ATR percentage, that volatility compared to the last 100 days, has pulled back to 1.69%, so that's half of what it was a month ago, and we're solidly into normal volatility. The risk index is still favoring riskier assets, the risk on trade, so that's favoring alongside speculative trades. And the risk Z at 1.12 is still abnormally strong, but it's kind of stabilized right there. And again, that's favoring the long side. The BMR, that should be updated to reflect next reevaluation is 1 July. And the current holdings for June are in the box of current leaders. So the Qs, tech, and consumer discretionaries. And if you took EWJ, you'd be in good shape too. The Dow 30 leaders, no surprise there. 4 out of the 5 are tech, and that's the holy quadrinity of tech plus Nike. Apple, Microsoft, Cisco, and Intel. Apple, because they've made the best transition to a change in the supply chain and manufacturing. Microsoft, because they have no weaknesses and their business model is strong based on services and support. Cisco, because they build out the internet, and that's not going anywhere. And Intel, because the entire chip sector just has had an amazing run, and they're positioned to continue to leverage that. So if you were just going to buy those 4 right there, the 4 tech leaders. ETF2 is up to 100% theoretical exposure. All of the indexes are now above the 4-month moving average, so that's favorable. So that's just a declaration that the bulls won. The bulls have won. Monthly market health check next. You can see the yellow zone is marked off as the width of the dragon, and the strong monthly move so far has taken it up to the PSAR flip and the edge of the floodplain at 320, and it has cleared, the yellow zone dragon there by about 3%. That's pretty strong. That is one heck of a recovery. The last time it sold off hard like that, there was a 5-month move before it really collapsed. So we've had a 3.5-month recovery so far. So still some room to the upside to push for 330 and 340, but it's getting up into nosebleed territory there. And I just think there's no other place to put your money. The real estate isn't earning any money for the commercial holders, so and negative interest rates. So where's your safe money? In large caps and tech leaders, with the promise of support from the Fed. I think that's the story. All of the red lines are support levels that used to be resistance levels, and that sets your price ladder on the way down if these were to break. The significant one to me is kind of the lower skin of the dragon at about 294, 293. That's got to really hold. I also think 300 is important, the spine of the dragon and the Z1, because that's a round number. I think that will have some psychological power. The weekly market health check shows the same kind of story, a tremendous rebound. We're in the spring on the Four Seasons. I see strong support there just above 300 at the Bollinger Band mean. That's why I think that number is significant. 330 is the edge of the river. 355 is the Z2 line. And we're supported by the PSAR underneath. So this is really all systems go. And the all-time high there at 340 is within reach. I just keep waiting for the other shoe to drop. The daily market health check, you see it was all surprise and joy and closed strongly over the weekend. And we're in a strong summer move now. You can see that 3 weeks ago, that little blue shaded box was the narrowest range week of the recovery. So we've started leg two. And last week was, or 2 weeks ago, I should say, was a good first step out of that consolidation area. This week, with the gains on Friday, was a double-sized step, and we're out past Z2 and halfway to Z3. The dragon support levels here at between 309 and 302, that looks to me to be really solid support. If that breaks, though, then it's back to the Bollinger Band mean. So I'm cautiously optimistic. I'm not going to itemize this too much. I got to save my voice for tomorrow. But the big takeaway on this is that the big winners in every portfolio over the last 1 week and 1 month are predominantly coming from the sectors and indexes that were most strongly beaten down. So you can see Latin America was amazing at 14 and some change percent this week, and 31% over the last month. And the same thing on ETF 22. I'm not going to read them all to you. Getting a little scratchy in my throat. And then ETF 32 has some big winners in there, including finance, energy, and Brazil. So all the beaten down sectors have really responded. And then the defensive plays like gold and treasuries are really giving it up right now. So that's a changing of the guard. Dow 30, big winners. Microsoft and Cisco on 3 months. But then the shorter term plays here on Boeing, Travelers, and ExxonMobil. Man, oh man, oh man. If there was ever evidence of the power of the Fed to print money, it's Boeing. Holy smokes. There's got to be huge congressional ownership of that thing, too, I got to believe. Sector spiders, big wins in regional banks, and then the whole energy sector did very well. And again, those were the beaten down sectors that have responded so nicely. This was the one that really jumped out at me when we talked about this in the workshop today, and that is, I want you to notice XSD, the S&P semiconductor. So this is one of the few symbols in which it was a BMR winner, so it's green on 3 months and 6 months, but was above average on 1 month and 1 week. So that's an indication that they are preserving their strength. They're not rotating out. It's a vote for tech and a vote for semis all the way, and looking good. And then the other one that jumped out at me was PBW down here at number 40. That was also really strong in the 6 month, basically flat on 3 months, and powerful moves on 1 month and 1 week. So those gains there say it's still early in its outperformance, and that's why semiconductors and clean energy are on my short list. Tech and discretionary are really strong there. All of the indexes are above the 4 month moving average in the world market model. Let me let that come up on your screen first. Sorry. Yeah, so all 10 indexes in the world market model are in a buy signal that puts us at 100% asset allocation strategy. The U.S. still leading the way. That should read bullish normal, mistyped. The strength in tech and discretionary XLY are clear. It's all equities. None of the other asset classes are close. And in the U.S. portion of the model, note it's the Qs are just killing it, and the small caps are lagging. So that's big money, big free money going into the large caps and weighted towards the tech leaders. And that's the way to continue to play it. Semiconductor index really stands out on the next chart. This is the one that shows the leading candidates from the ETF2 database. Let me let that come up on your screen. This one does a good job of highlighting the new leaders. So we're looking for green in strength and white on consistency. And it's the semiconductor indexed, consumer discretionary, Russell growth, S&P growth are just leading the way. And then the oil and gas exploration, I don't know if I've ever seen that before, green and red. It's not even on my strategy chart up there. That's just how amazing the recent run in XOP has been. So that's clearly where things are working. Shift to the daily. I'm sorry. We'll just shift right to the daily. I just want to highlight on the overreaction system there that it's EPP and ILF are the ones that, if there's weakness in this week ahead, then those would be the ones to exploit on the way down. 10-day max pain, there's still wiggle room in there for Walmart, JP Morgan, and Pfizer. And even surprisingly, Boeing still has a way to go. In the Dow tactical summary next, there's just a lot of things that have that would be triggering the OR overreaction short, simply because of the size of the bounce. Let me let that come up on your screen. Yeah, so those really jump out. Walmart, Pfizer, and Johnson & Johnson are just on my list for real exploitation of value. Among the ETFs, the defensive plays, gold, silver, and treasuries got smashed the last week, and the whole energy sector looking good. XOP, XLE are good, and then UDOW is just to me, is the index of choice if you're trading the leverage indexes right now, because the Dow's been outperforming. The auto framers up next. That is self-explanatory. Plenty of targets to choose from. A lot in the energy sector. I'll let that come up for you. In the regression line fractal frameworks, the top shelf in green still are the deep value plays. Walmart and Coke stand out on the stocks. The bottom shelf is just really revealing who the winners are, the relative strength winners: Cisco, U.S. Steel, Home Depot, and that's where I'm going to be looking to reward more momentum. On the MACD, Four Seasons, just about everything's in the summer because of the nice big run up on Friday, and then multi-time frame NDX after that one. Take your pick. So many things exploded through their look back periods that it's really a buyer's market here. But to me, on the Dow, it's U.S. Steel and Apple are really of interest. And then on the ETFs, the Qs have really come roaring back. And I guess XOP, the oil and exploration, still has has some nice gains left in it. That's everything I want to cover from the daily. I want to just show a couple charts real quick for you that I thought really went over pretty well today. The first one, the idea, this chart really seemed to express pretty well the idea of managing with 4 bullets, how to think about managing your risk intraday with how much exposure you have. And this point really resonated well, that I am always stalking, I may be trading, because there was some discussion about, well, we see how you manage your trading day according to the plan, but in the moment when they're juggling symbols and charts and all that, how do you do that? And so to me, it's a combination of strong mental discipline for always stalking, and then you have to convince me it's time to trade something. And then the use of the bullets and the span of control of 4 is a way to keep from, getting distracted. And I'm really only looking for like 2. My favorite kind of a day is when I have 2 symbols that are really working and I'm trading them well and I'm making my daily objectives. That's really what I really need, because I can get 2 or 3 positions on them at one time, and I don't really need to try to get every possible thing as long as it's working reasonably well. And then this psychological point of you get to define your game of what kind of trader you're going to be. You define your game, you make the rules for yourself, and then you play it. So you don't need external validation. You just need to do what you do. And part of that is having the confidence in your skills and the ability to get into the zero state so that you've optimized your mental state for trading. To me, that's just really reinforcing how important that is. This one was a nice discussion. This next one on how to select targets by taking a sample of symbols from many different buckets in the world market model, and then creating a chosen set or a herd that features markets, indexes, sectors, companies, and any special symbols you like. And that from that herd, that subset of symbols, and for me that's probably about 50, that I'm studying that for signals in order to produce a prep list. And those come from new signals for swing trades, continuations, and then the old reliables. And that prep list gets framed according to the rules of standard work. So it's always the same frame, nothing new here. And that once I've got those individual trade frames, I go through a series of contingencies and scenarios about what the market could do, or what the gaps could do, or what the logic chain looks like. And that the logic chain and the trading plan work together to create, and then get expressed on my trading platform, which I rehearse. And then when I'm executing, I'm just using standard patterns, same ones every time, every day, nothing weird. And that's just standard work. And then the 4 bullet concept for managing the money and managing time, will, pattern, and money. I'm ready to trade, and then I just execute without thinking and just then assess it later. So this really suggests that the way you select your herd really matters. And to me, a good herd, a good chosen set, has a mix of all those elements. You have some markets and some indexes and some sectors, etc. And then something is always working, something's always on the move. And you have diversity across asset classes, and then diversity across life cycles and seasons. So you should have some things in the winter, some in the fall, some in the spring, some in the summer. And that way you have a variety of strategies and a variety of directions. So whichever way the market is reinforcing, then you have something in that season that's working. And then the common features of all those members of the herd are that they have enough volatility to trade, that they have enough volume to be useful, and that they have a certain reliability and movement, like a good frog candidate. So this was another just kind of a restatement of how you go from the plan all the way down to execution. This next one was a nice illustration of the idea that the chain trading, that once you started off with a hybrid frog and it trades in a certain direction till it comes to that diamond, that decision point, and it's either going to resolve by going north for a supported spring crossing, then maybe an owl, and then maybe an emerging dragon when it really works, or it's going to fail from there and go into a supported winter crossing and then a collapsing dragon. And so when the hybrid frog works, that first leg is an unambiguous move. Well then, the size of that move implies the size of the next move, because that's how strong the traders that won, that's how strong they were able to move it. But then when all of that back and forth settles down into a sideways quiet channel, then might become a Z3P, and then might become a super pinch, you have another critical state. And from that critical state, that range compression is like building up potential energy that's got to discharge in one direction or the other. So then that looks very much like a hybrid frog at the start of the day, only it occurred whenever it occurred. And then on a swing trade, there's no hybrid frog, so you're kind of always starting with something that has collapsed into a doji and given you some sideways quiet channels in a critical state. So that's sort of the evolution of the life cycle of the trade. This one was, I'm not going to repeat this one again, but this was a good discussion of why I choose regression lines and how to measure them and what the straight line regression line means and how the moving regression line works and how that simple mathematical simplification, that adaptive tool, becomes the building block for the slope statistic, for the RLCO patterns like the RL1030 crossover, and then gets built out into the regression line fractal framework, all with the central idea of what does that regression line represent and how do I know how strong it is for relative strength? Because I'm measuring things against themselves, against their peer group, and against the market. And how well it's doing is reflected in that traffic lighting structure, which is common to all of my statistical measures. So that was a pretty good discussion. This one, you'll be interested in this when we get it done. This was sort of just a summary of how do you pick the initial risk. The left-hand side of the wall is how you do it when you're working from a frog box starting point and you're using statistics to reduce the frog box down to the minimum manageable risk box in order to get the smallest open risk that you can so you can get to no lose plus dinner for two quicker. And then setting that MMRB equal to a minus 0.2 position sizing risk so that you can just manage this like a poker chip. So you're not living and dying on each individual decision and tearing your guts out. On the right-hand side were 4 different functional patterns, or an idea where the hypothesis that we were testing, whether it was a visual box, the supported spring crossing, or the VWAP magnet, or the RLFF trade, or the Z-score trade, any of those all have particular hypothesis that comes from the lens that we're using to make sense of it. And then in those, there is a price according to that theory, which says that this hypothesis no longer works. Like when you frame the supported spring crossing and you use the initial PSAR flip dot to be your risk, the theory tells you how big that box is, and your job is to not take more than a 1R loss. Well, whichever side of that fence you're on, your ultimate destination is that MMRB in the middle, the minimum manageable risk box. so that you don't take more than a 1 hour execution risk. You got to internalize that habit of mind. Then all you have to do is find a critical state, given a critical state, a reward to risk hypothesis, knowing what the price is that disproves the hypothesis, and then a trigger to entry. Now you've got a trade with a initial risk established. Then if you can manage this discipline of the execution risk being a minus 0.2 and treat it like the ante in poker, just so you can see that's the price you got to pay to see the cards, you're in good shape. This one went over pretty well too. How do I start? Now. You start now. That's how you do it. You go slow and steady, and you trade, and you study your trades, and then you get better. Just like anything that requires practice. You don't get better at drumming by not drumming. So in my view, what you do is you got to get into a good practice habit, and then paper trade forward so you can feel what it feels like. And then when you're ready, trade one share at a time and see what it feels like with skin in the game with your accountability partner to help you. And then once you're ready, you can move up to $25 a risk per trade. And then when the stats support it, 50, then 100, then 200, and you go through scaled production, all the way up to full rate and surge production. So that's how you get started on the systematic approach. How do you get started on the technique side? Well, it's all craft work. Start with a few targets, like understand the S&P, SPY, and then practice your 1 minute trading with the supported spring crossing on DIA and EWZ. Compare your result charts against those that are posted in that challenge room and master that pattern on those two symbols. And don't do anything else until you master that pattern on those two symbols. Then you can decide what your next path is. I would say add 2 more patterns, the supported fall crossing and the supported winter crossing. And then that way you will have multiple ways to trade your 2 patterns or your 2 targets. When you've mastered those, then you could add some symbols from that second tier, like the XL series, KFB and E, or Mexico and XOP, or one of the individual company symbols that we track. And as you keep mastering one of those patterns on the bottom side, you can add 1 more pattern and keep going through the same challenge approach until you master that pattern. And then get all the way up until, go through the Z3P and Super Pinch and the Hybrid Frog and the RLFF. Do that. At some point, the owl wisdom of how to look at those things as a continuous chain becomes chain trading. And you won't be able to do that until you just start trading. Slow and steady and trade. Learn how to do it. And this was the phrase. How do you start? Well, you frame trades and then you trade the frames. That's all there is. Frame the trade and then trade the frame. Don't trade anything that you haven't framed. And that's how you get started right there, in my opinion. And those are some things I'm doing for tomorrow. So those were the big ideas from the workshop that I wanted to share with you. And I'll get this thing built and posted later tonight. But I still got about 2 more hours of processing on we're in the middle of the other system, or the other podcast being produced right now. So that's everything I got for tonight, guys. I'll take a look at we're going to work on trade frames in the workshop tomorrow, and I'll hit some of those highlights tomorrow night at 8. So that's all I got for you tonight. And I got to save my voice for tomorrow. So take good care, and we will see you in the chat room. Frame those trades.